Good morning and welcome to the Benchmark Holdings PLC Analyst and Investor presentation. Throughout this recorded presentation, by the Q&A tab situated on the right-hand corner, up your question and press send. The company may not be in a position to answer every question received during the meeting itself, however, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Trond Willikson, CEO, and Septima Maguire, CFO. Good morning.
Good morning, and thank you for the introduction, and good morning to all of you, and welcome to the year-end financial year 22 presentation for Benchmark. As introduced, I am Trond Willikson. I'm the CEO of Benchmark, and as usual, I'm here with our CFO, Septima Maguire, and we are here to give you insight into our financial year 22. Covering financials and main events as well as outlooks for the company. As you likely have seen, we have issued two important announcements this morning. One of these is on the results for financial year 22, and one is on us now moving on with the listing at Euronext Growth in Oslo. Both of them will be covered in this presentation. But let me start out with some highlights from our financial year 22. We are happy to announce that we have ended our financial year with good strategic, operational, and financial progress in Benchmark. The last quarter of the financial year was no exception to what we have shown in the quarters earlier in the year. Q4 was a good quarter for us, ending what we see as being a very strong financial year. The main numbers, they speak for themselves. We managed to lift our top line by 27% for the year, reflecting strong growth in all our three business areas. Even more important, we have grown our earnings from operations even more. For financial year 22 in totality, we have lifted our adjusted EBITDA with 60% compared to last financial year, ending with adjusted EBITDA of 31.2 million for the year. This corresponds to an EBITDA margin of 20% for the group, an increase from 16% in financial year 21. Q4, a strong quarter, represented a continuation of the consistent growth and improvement of operational results quarter by quarter that we have shown since we finalized the restructuring at the end of financial year 20. This consistency in delivery was what we set out to achieve. This has been what we have been delivering on, and this is what we aim to continue to deliver on in the time to come. Even if the financial results from our operations show very strong development, and we have improved our cash conversion, our operational cash flow, and free cash flow compared to last year, we are still not where we aim to be from a P&L perspective, reflecting in an operational loss of 7.9 million for the year. This loss is heavily influenced by increased depreciation related to the commercial launch of Ectosan and CleanTreat, which we did last year. In the very first year of introduction of this solution to the salmon industry, the activities have not been sufficient to cover the burden of 10 years of development now coming through in our P&L as depreciation. This is not a large surprise to us, but it's nevertheless not a situation we intend to stay in for a long time. Financial year 22 has been a very busy year on many fronts, and I'm really proud of the whole organization in Benchmark that really has responded well and worked incredibly hard to meet our targets. One of the milestones achieved is the successful refinancing of the group with a 750 million NOK green bond. After year-end closing, we have also refinanced our RCF. We managed to do this refinancing in a market that everyone knows has turned to the difficult side. Now having this refinancing in place means that the group remains in a strong financial position. We're ending the financial year with cash of 36.4 million and available liquidity of 45.8 million. The fact that we managed to qualify for green bond financing also reflects the strong efforts we've had over the last 2 years to live our vision of being a company with strong ESG credentials. We have undergone a strong transformation from talking about sustainability to actually living it, systematically working on a range of areas from net zero commitment, sustainable sourcing, animal health and welfare, to real engagement to the societies we are part of. This way of operating and thinking is embedded in us and will be further strengthened in the years to come. A main topic of the year has been the listing in Oslo, the world's leading aquaculture and seafood listing venue. As we have announced now in a separate RNS this morning, we are now moving ahead with this listing, in the first instance with a listing at Euronext Growth. Connected to the listing, we are doing a limited placing and retail offer of shares to fill the listing and free float requirements for Euronext Growth. The placing is limited to 5% of the issued share capital. Books will be open from December 1st to December 6th, and we intend to have our first day of trading at Euronext Growth on or about December the 15th. As previously stated, our intention is to uplist to Oslo Børs within first half of calendar year 23. The board will also consult with the shareholders on whether to maintain its current AIM listing. Then, moving over to more granularity on the performance in the quarter in the three and the year in the three business areas. Starting out with genetics, where we have had a very strong year, a year where we really have seen growth from invested infrastructure come through. For the financial year in totality, we have seen a growth of 24% in revenues to 58 million. At the same time, we have seen earnings from operations, adjusted EBITDA, grow by 76% compared to last financial year to 14.4 million, excluding fair value uplift. The driver behind the strong growth in revenues and earnings is the strong development within salmon genetics, where we have seen record high sales of salmon eggs out of Norway and Iceland. Especially Iceland has had a particularly strong development. On the back of the investment we did there in a new incubation center, we've been able to take advantage of strong demand for our salmon eggs, giving us better utilization of that facility than we expected. The new incubation center has really been a good and timely investment for us, both from a quality but also from a volume perspective. And given the experience on the supply of local eggs and salmon eggs in Norway, close to 50 million eggs were sold out of our facility on Iceland to supply the Norwegian market in the financial year. Our Chilean salmon egg business has had its first year of operations. The operation is going well, but the number of eggs sold are still at the low end, as we would have expected. Our effort to penetrate this market in a responsible way continues, helped by us now having also an organic certification in place. Like our salmon egg business in Chile, our SPR shrimp genetics program and our genetics program on tilapia remains growth vectors for us in the future. In our shrimp genetics program, we have seen good commercial progress over the year, exceeding our sales targets for the first full year of commercial operations. We continue our efforts here to tailor the genetics to different conditions in different markets, being on a journey where we aim for a significant position in the total market over time. Both for our shrimp genetics program and for our tilapia genetics program, we have completed the investment in needed infrastructure for the next phase in the commercial development and growth. Key for us as a leading genetics company in aquaculture is to make sure that we stay in front on science. This is also why we are focusing on strengthening the genetics scientific team with new world-leading resources. The recruitment of Dr. Ross Houston to lead our genetics R&D activity is part of this, and further high caliber resources is now being added to complete our scientific team in that area. Moving over to our largest business area, Advanced Nutrition, where we have seen continuation of very strong commercial performance throughout the year. Our top line growth within this area ended at 14% for the full financial year, while our adjusted EBITDA grew by 38% to 19 million. I would also like to mention that this is a business area where we have been able to triple our adjusted EBITDA over the last 2 years. A dominant part of the progress that we have experienced is a consequence of enhanced operations and sharpened commercial efforts by our excellent team in INVE. Yes, we have been helped by improved market conditions in the shrimp market since the early days of COVID, but the growth we have experienced also in this financial year outperforms the underlying growth rate that we have seen in the market. All in all, our Advanced Nutrition business has ended a financial year with growth in all our three product groups. We are also especially happy with the rebound and growth we have seen in Ecuador, which is a key production region for shrimp. But we are also seeing good developments in other markets, not only in the shrimp industry, but also in the marine finfish industry. Key to us over the last 2 years has been to optimize our operations and strengthening our commercial team and efforts. We have also been working on streamlining our R&D activities. The efforts we have done on these areas have given good results and will still be a strategic priority for us in the time to come. And as will our efforts to launch new technologies, as well as developing our activities to become more sustainable. Finally, when it comes to the business area performance, onto our health business, where we saw good progress in adoption of Ectosan CleanTreat, the Ectosan CleanTreat solution in the last quarter of the year. Coming out of June, July, with very low utilization of our 2 vessels that we have deployed, the picture has changed considerably, entering into the main sea lice season at the beginning of August. Since then, the uptake of the solution has been good. One of the 2 vessels we have deployed is on a charter with the main salmon producer, while the other vessel is utilized in the spot market, doing treatments for an increasing number of salmon farmers in Norway. Given that we have very low utilizations of the vessels in July, the financials for Q4 does not reflect the increase in adoption that we have experienced from early fall onwards. The financials for the financial year is in total also mirrored that we have been through a first year of operation after the introduction of the solution. Even if we obviously are not satisfied with the financial performance in our health business area for the full financial year, we are conscious that we have used the year well on work and investment necessary to increase the efficiency and adoption of the solution. We are also satisfied that we have gotten confirmation that we have a unique solution that is on its way to become an important tool for the industry in solving the sea lice issue, as all the fundamentals of the solution has been confirmed. As stated, when we did our Q2 and Q3 presentations, we are on a journey towards making the solution less costly, more adaptable, and less capital intensive in the future. Key is integration of the CleanTreat technology into the infrastructure of the farmers, taking down the cost, risk, and CapEx, both for us, but also for the farmers. This work is ongoing every day and will do also in the time to come, in close dialogue with farmers, but also with partners that could play a role in ensuring we are enabled or assured that we are able to take out the potential of the solution in the future. Finally, a few words on the development of the group as a whole, financial year 22 has really been a year of significant strategic and operational progress, and another year with strong commercial focus to drive financial progress in all the three business areas. This is what you have seen from us so far. This is what you should expect to see from us also in the time to come. Will the commercial progress again be a straight line development? Probably not, but we are very determined on the direction of travel of the group. Taking out synergies from being one group, one benchmark has very much been on our mind over the last financial year. Tangible changes that has been made over the last year is alignment of resources across the group on commercial, marketing, sustainability, R&D, and people functions. This is key to take out operational efficiencies in the group, and something that we will do even more in the time to come. We will also continue our work to drive culture change as well as driving performance through a very well-defined performance framework based on clear strategic priorities. This is really driving performance in the group. And finally, our work to deliver on our commitment on sustainability and ESG has been and will be a strong priority for us. In financial year 22, we have made good progress towards our net zero commitments, as well as on a number of other areas crucial to improve our standing as an ESG company. Needless to say, this will be a key focus for us in the years ahead of us. So, with that introduction, I am leaving the floor to Septima to take us through our financials in more granularity. So, over to you, Septima.
Thank you, Trond. Financial year 22 has been a year where we have made significant progress. We now have 3 business areas which are fully commercialised, and this shows through in the numbers, with strong revenue growth driving improved adjusted EBITDA, up 60% to 31.2 million. And from a quality of earnings perspective, adjusted EBITDA excluding fair value uplift rose 83% to 29.6 million. As Trond noted, our operating profit was impacted by the higher depreciation and amortization charges associated with the rollout of Ectosan and CleanTreat. During the year, we also refinanced the NOK bond, and this resulted in significant non-cash movements of the hedges and a write-off of the deferred fees, financing fees associated with the old bond. In addition, we incurred a one-off penalty for the early termination of the old bond. But fundamentally, we're extremely pleased to have the refinancing in place as we look to the future. Moving on to look at revenue. We've closed the year with a continuation of the consistent delivery theme that we'd seen in the business since the restructuring. With continued revenue growth in all business areas, we've made steady progress, with strong growth in nutrition and genetics, driven by our well-established core businesses. And with the newly launched Ectosan Vet and CleanTreat, Health has also seen good growth in the year. This has driven growth from financial year 20, which was the year of the restructuring, to financial year 22 at a rate of 50% for the 2 financial years combined. A very strong step in the right direction. So moving on to look at how does that translate into adjusted EBITDA? Well, the growth in sales in all of the business areas delivered strong gross profit, and with good cost control, this resulted in adjusted EBITDA growth at an absolute level. But also, we've delivered strong progress on our adjusted EBITDA margin, moving from the 14% in financial year 20 to end this year at 20%. We've delivered a strong set of results in each business area. Nutrition coming out with strong commercial and cost focus. Genetics delivering excellent growth in the core business in Norway and Iceland, which continue to fund our growth areas. And Health moving from a loss of 2.7 million last year to a positive contribution, albeit incremental, of 0.1 million this year. In addition, from a quality of earnings point of view, our net exceptionals were nil during the year, with income from previous disposals offsetting costs associated with the work to be done around the new Oslo listing. We'll move on to the next slide. So just to move back, halfway through the year, we communicated our medium-term financial objectives to aid investors' understanding as to how we're moving the business forward. As you can see, we've progressed towards our financial objectives in financial year 22, delivering strong revenue growth of 27%, which has driven good margin expansion, bringing the adjusted EBITDA margin to 20% towards the target margin of 25 to 30. And with stronger cash conversion of 35%, we've been able to move free cash flow in the right direction towards the target free cash flow. How does this translate into the objectives for the business areas? We continue to drive each of the business areas forward with strong objectives for revenue growth, good cost control, good cash control, ultimately taking the business to profitability and cash generation. In genetics, the levers for growth are, of course, expanding into the invested capacity of Norway and Iceland and penetrating the market in Chile for our salmon egg business. In addition, growth will be supported by the newly launched shrimp and incrementally by our tilapia expansion. In nutrition, we expect to grow ahead of the market, which has been supported by our results within this financial year. And in health, as we gain traction in the market for Ectosan Vet and Clean Trait, we're getting better profitability and cash generation from this business area. So let's dive in and look at our business areas in more specifically. So starting with genetics. Genetics had an excellent year with revenue growth of 21%. Solid gross margin and good cost control took the adjusted EBITDA margin to 28% on an adjusted EBITDA of 16 million. Excluding fair value uplift, adjusted EBITDA was 14.4 million in the year, a growth of 76%. This result, as Trond noted, was linked to our ability to meet an increase in market demand for salmon eggs, which we were also able to supply from our newly invested incubation house in Iceland. Whilst the new incubation house only officially opened in August 22, we were able to start ramping up capacity and utilising it before that. And so this resulted in the total number of eggs sold increasing by 24% to 291 million. In other salmon revenue streams, harvest revenues were higher, benefiting from the high salmon prices during the year. And newly launched Salmon Chile has moved into the commercial phase, and we continue to focus our efforts on penetrating that market. On shrimp, we commercially launched during the first quarter of this financial year, and we continue to focus our efforts on growing this market. As we've now commercially launched, we've ceased capitalising costs, and now all of the costs are flowing into adjusted EBITDA. And within tilapia, the tilapia expansion was delayed due to COVID issues, and therefore we didn't complete it in place for the full year, albeit we should see the effect of it coming through in financial year 23. Moving on to the next slide. So, as I noted, genetics had a very strong year, with the core business of salmon in Norway and Iceland delivering over 22 million of adjusted EBITDA, of which 1.6 million related to fair value uplift. This momentum allows us to support our newly launched businesses, which are not yet profitable. In total, we invested a combined adjusted EBITDA loss of 6.5 million in these areas. And that was driven by a full year of commercial costs for Chile and a half year for shrimp. And of course, tilapia expansion being delayed, we were not able to achieve the full year's production during this financial year. But with respect to these projects, now that we've closed out the large capex on these growth areas, the focus is on driving profitability and cash generation within these areas. So moving on to look at nutrition. It's a very important part of the business from a profitability and cash generation perspective. Nutrition continued to deliver good progress during the year, with revenue growth in all product areas, showing the continuation of sharpened commercial focus in place since the restructuring. The growth was also supported by strong currency tailwinds in the business area, as the US dollar was strong throughout the year. But also, the increased revenue drove better manufacturing volumes and resulted in gross margin increasing from 51% to 53% in the year overall. This, coupled with excellent cost control, even as we invested into the commercial apparatus, drove adjusted EBITDA growth to 19 million and adjusted EBITDA margin to 24 million, a very strong result. Moving on to health. Health has made significant progress in the year, with the first full year of Ectosan Vet and Clean Trait. During the year, We had one vessel with a clean treated unit aboard operational for the full year, and the second unit came online in December 21. Combined, they delivered revenue of 14.8 million, of which 2.5 million related to revenue associated with vessel-related costs. Gross profit increased by 4.6 million to 8.3 million. This increase offset an increase in operating costs of 1.9 million and ultimately moved the business area from being loss-making in financial year 21 with an adjusted EBITDA loss of 2.7 million to an adjusted EBITDA of 0.1 million positive. We still have progress to be made in this business area to move it forward towards its target margin. But with the full year's operations completed, focus is going to be on improving profitability and cash generation in this business area. So moving on to focus on operating costs. So these grew at an absolute level, but reduced as a percentage of sales. The growth at an absolute level was driven by the increased activity in core business and costs associated with commercial launches. Whilst OPEX increased, R&D decreased in the period as we ceased capitalising costs associated with the development projects. Our main focus in ongoing R&D now surrounds the breeding nucleus in salmon and our ongoing development projects in our nutrition business area. So moving on to look at cash flow. So as you can see, as part of the restructuring, we invested significantly in the business, in both the core established businesses to get them caught up from an investment perspective, and then invested in the development areas to allow them to commercially launch. So we're now sitting with 3 business areas which have all of their development projects fully launched. With this new commercial base, we can expect that our operating cash flow, which initially became positive in financial year 21, will continue to grow, and the quality of earnings will support this. This, of course, will then, with more moderate capex as we move forward, allow us to grow our overall cash flow generation and become cash flow positive. So one of the areas which is important from a cash flow point of view is, of course, our working capital. So this is an area of significant focus for us as we move forward. As you can see, working capital grew at an absolute level, but remained stable as a percentage of sales. But we want to focus on taking this percentage down in the coming years as we grow the business and, more importantly, unwind some of the cash caught into the working capital. In health, the working capital increased through, of course, the ramp up of Ectosan and Clean Treat, but also we moved the third Clean Treat unit into inventory, given our intention to move to a new operating model where we sell the units directly to the customers for use within their infrastructure. Genetics inventory also increased due to the increase in biological assets. We've got more broodstock and also more eggs due to the ramping up of our facilities in Norway and Iceland. And in nutrition, we'd increased inventories of Artemia, but also higher overall inventories due to slightly increased safety stocks in place to combat logistical challenges. Moving on to net financial expenses. As you can see, there are a number of moving parts within the finance costs, but there are 2 main items to note: the closeout of the old bond, which resulted in the early settlement penalty, and the increase in amortization as we wrote off the remaining deferred financing costs. Additionally, you can see the significant swing of 9.1 million, the non-cash movement on the cash flow hedges, as the old hedges were closed out and newer hedges were put in place. In terms of the interest on bond debt, we expect this to remain around the current levels in the next financial year, based on the financing costs of the new NOK bond. And then finally, the interest on finance leases increased due to the leases associated with the PSV vessels as part of the overall Clean Treat operations. Moving on. So as you can see, with improved trading came better cash generation, with cash from operations after working capital of 18.3 million. And then within the capex figure of 12.7 million, we had the capex to complete the incubation house, a very important investment for us, and also the cost of the third Clean Treat unit. As we previously noted, with Clean Treat moving to a customer infrastructure and lower overall capex within the rest of the business, we expect the capex burden to be more moderate going forward, which is an important tool in moving us to be cash flow positive. Trond and I have both noted our desire to move the business towards positive cash flow, and we've got a number of levers we can use to support this. Better trading, of course. Strong trading supported by good cost control is very important to us. Unwinding some of the working capital, as we've noted before. And of course, moderating the CapEx burden with our core businesses, having been invested in over the last number of years. Now it's time to get asset utilisation out of that business and moderate the CapEx. This will allow us to push forward towards positive cash flow in the coming year. Moving on to the next slide. We have, as Trond noted, made significant progress this year, not just in moving the business forward, but also with respect to ensuring that we've got the right foundations for the future. And of course, an important part of that is our financing. During the year, we refinanced our old secured 850 million NOK bond and replaced it with an unsecured green 750 million NOK bond with a maturity of September 25. In addition, we also refinanced our debt associated with Salton, consolidating facilities and extending the term out by 5 years. And finally, we refinanced our $15 million RCF and replaced it with a £20 million RCF with a maturity of June 2025. Having these facilities in place allows us the flexibility to focus on the business and cash generation, knowing that we're well financed as we move towards the future. Back to you, Trond.
Thank you, Septima. And now on to the outlooks from where we are today. And after ending financial year with strong progress, I'm happy to say that we have a good start of the new financial year with good momentum actually in all the 3 business areas. That gives us confidence. I think it's obvious for everybody that we are living in a more unsure world at the moment with numerous issues that could impact any business. Our focus, given these surroundings, is to do what we can to optimize the performance in our business and not allowing ourselves to be too distracted by uncertainties outside our control. I would like to remind you that we are a very diversified business. We are very well positioned, delivering mission-critical solutions, and that's key here. Delivering mission-critical solutions needed anyway to the global aquaculture industries. So coupled with a proactive commercial approach, this creates resilience and mitigate potential impact from ongoing cost inflation and macroeconomic pressures. I would also like to just to mention that the recently proposed new tax regime for salmon producers in Norway. The way we see it, it will have marginal effect, direct effect on our business. Everybody will be affected, but we think we will have a marginal direct effect of it. To the extent that we see implication, it will be related to the growth rate of the salmon production in Norway in the years to come. It might be slowed down a little bit from where it was, even if the intention with the tax regime is to keep on growing the industry. This morning's announcement mentioning that we are mentioning the Euronext listing. It should be needless to say that we continue our progress towards this. We strongly believe this will be beneficial for the company and the shareholders, placing the company in the center of the strong aquaculture cluster surrounding Oslo Børs. On a final note, let me just repeat to you why I think and we think that Benchmark is a unique company, a unique value proposition, and a unique investment proposition. We are in the aquaculture industry, and we are happy to be in that industry. It's a young industry, it's a prosperous industry, it's an industry that will play a crucial role in the global food supply in the time to come. It is an industry that will give structural growth for those companies who are well positioned in the aquaculture industry. And this is what Benchmark actually is. Having market leading positions in everything we are doing, having market leading positions in products and solutions towards the three main species within aquaculture. In sum, what we are as a group is a unique but mature biotech platform. So unique, I don't think you find anything like this. Well invested and positioned for growth in the future. We've done the groundwork. We've been through the different development stages in the company's development. We've been through a rapid development or expansion phase. We've been through a necessary restructuring, and we are now in a phase of consistent delivery with strategies and a framework to deliver good returns going forward. And finally, we are more than just an ordinary company. We are really a purpose-driven company that really has a good purpose with a very, very strong organization and a very strong ESG credentials. So with those words, repeating why Benchmark is so unique, I will leave it up back to you, Paul, to sum up and take it us.
Fantastic. That's great. Trond, Septima, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions just using that Q&A tab situated in the top right hand corner of your screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation along with a copy of the slides and the published Q&A can be accessed via your investor dashboard. As you can see, we have had a number of questions submitted and they're flying through now quite quickly. I'd like to hand over to Yvonne, if I may, just to host the Q&A. Yvonne, if I could just ask you to please read out the questions and direct them to the team where appropriate.
I can't hear Paul, but I assume we're moving on to questions. So yes. First question for Trond and Septima. In terms of the company's expansion into new markets, what comes next and how long do you see it taking?
It depends on which part of the business you're talking about, because when it comes to new markets, you have different markets for the different business areas that we would like to enter into. If you just take it systematically, when it comes to health business, Ectosan and CleanTreat, we are focusing in Norway now, and I think it has been right to focus on Norway. It's the biggest market. More than 50% of global salmon production is there. As we have announced, we have now a marketing authorization also in the Faroe Islands. It is very close as a next step. But I think over time, moving into Scotland, Canada, and eventually Chile is the route of development there. In terms of our genetics business, it's obvious that we have three growth vectors there. We have our salmon genetics business in Chile, which is really still worked on in order to take our fair share of that market. We have a growth vector when it comes to SPR shrimp, which has numerous markets to enter into. And we have our growth vectors related to tilapia, which also is in a starting position in terms of commercialization and numerous markets to enter into. In terms of advanced nutrition, it's a continuous incremental process, where we are, of course, taking care of the markets that we already are in, but we are also constantly seeking new markets and new opportunities with the product range that we have. And that really has a place in all the markets for shrimp and marine finfish all over the world.
Thank you, Trond. The next question is for Septima. Could you talk around cost inflation and trends?
So we are not immune from cost inflation. I think the world as a whole can say that. But we are somewhat unique in terms of one of the areas of significant cost inflation at the moment is energy. And we are lucky because we have access to low-cost energy in some of our territories where we have production facilities. We've got access to low-cost energy in the north of Norway, where we have a Salton genetics facility, and also in Iceland, where we have geothermal energy. And then in addition to that, one of our larger energy utilization facilities would be our plant in Thailand. And during this financial year, we put in place a program where we were going to put solar panels on that. ultimately to reduce costs, but also to help us towards our net zero goal. So we are addressing that constructively in terms of our cost base, but also in terms of our net zero emission goal that we have in place from an ESG perspective. From a practical point of view, we've also been focusing on better manufacturing efficiencies within our production facilities, particularly in our nutrition business area. And you can see that coming through as we've been able to increase our gross margin within that business area from 51% to 53%. But it's an area that we focus on every single day, every single week, between our procurement departments, our people departments, and also most importantly, the biggest tool is also passing on appropriate price inflations to our customers so that we can moderate the impact on our business.
Thank you, Septima. Another question for you. Can you give some guidance for 2023 CapEx, and leading from that, when do you expect to be cash flow positive?
So in terms of the CapEx for 2023, we're aiming between the sort of 6 and 8 million. We have one kind of core project in genetics, which is the tank expansion for Salton, which we started in financial year 22 and we're going to complete in financial year 23. This will allow us ultimately to push towards 150 million egg capacity that we believe we can produce and sell out of Salton in the coming years. And then, of course, there'll be other CapEx projects, but we are reviewing our CapEx to try and moderate it for this financial year. When do we believe that we are going to be cash flow positive? We are really heavily pushing towards it this year. It's always a struggle because there are many factors that would feed into this, but it's always been our commitment that our stated objective was that we wanted to be cash flow positive within financial year 23. And both Trond and I, it's our daily mantra with all of the business areas.
Thank you, Septima. The next couple of questions are around Ectosan Vet and CleanTreat. Can you provide some further details on the use of the third vessel and the related economics or business model? And how and when do you expect to commercialize the MA in the Faroe Islands?
The last question I would not give you a time on, to be honest, But we have a marketing authorization there that gives us the opportunity going forward. In terms of the commercialization of the third vessel, well, we have 2 vessels in operation now. Our focus has been, given the increased adoption of the solution, has been to make sure that we get as good utilization of those vessels as possible. That is first base, and we have progressed on that. The launch of the third vessel will be dependent on the further development of the uptake, but also the timing of when we can deploy that vessel in a way that is more in line with the future business model that we have been sketching out, where we actually are trying to sell with the right to use the technology to the farmers, to integrate it into the infrastructure of the farmers, which takes down the cost for both us and the farmers, takes down the risk for us going forward. We are actively working on that, but to give a certain time on when we are going to do that, I will not do. The only thing I will say is that we'll do it at the right time, for the company.
Thank you, Trond. The next couple of questions relate to margins in our business areas. Firstly, on genetics, do we expect to retain the very strong genetics margins in FY23, or should we expect margins more in line with medium-term target? And then in respect to advanced nutrition, how should we think about the progression on the advanced nutrition margins?
In terms of the genetics business area, we have seen an uptick in margins in financial year 22, and we'll expect positive things to continue through that. Will we be able to maintain that as our target margin? We had stated that our maximum target margin for genetics was 22 to 27%, providing we're in the realms of that with a growing business. I think that will be more in line with sort of medium to long-term objectives. The reason I say that is because as our new initiatives come through and start becoming margin accretive, then we might see some dilution in terms of the margins. In terms of nutrition, we have had a good year. We will expect to reinvest some of that potentially back into the business in terms of making sure that we've got a strong R&D pipeline coming through in terms of building our product portfolio, and also investing in the commercial apparatus to drive sales for the future. So as long as we can stay within our target range, I'm going to be happy.
Thank you, Septima. And finally, what caused the delay in tilapia?
It was literally delay in building materials, or actually inability to access some of the building materials. So we would have had to go back and find replacement materials for some of the build work that we had when we were doing the expansion. Just to reflect, the tilapia expansion, the purpose of it was to allow us to produce tilapia all year round. Previously, we'd only been able to produce sort of 7 months of the year. And so now with that in place, I'm expecting to see financial year 23 an uptick in terms of the profitability around that as well.
And tilapia, the delay on tilapia is one of the few areas where we are actually blaming COVID, but that was actually COVID.
Okay, we have no further questions.
Fantastic. Yvonne, thank you very much indeed for hosting those, and thank you for the responses from the team. Having covered all those questions, of course, there are only further questions that come through from attendees. The company will be able to review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Tron, perhaps before redirecting the attendees to give you some feedback, which I know is particularly important to you, could I just ask you just for a few closing comments, please?
Yes, my closing comments will be that I hope everybody sees that we have ended a strong financial year 22 with good operational and strategic progress, good advancement in all our 3 business areas. This is what we aim to do, and this is what we have been delivering on. I hope also it comes through very clearly that we are in a consistent delivery phase in the company now, and we have been that since we ended our restructuring at the end of financial year 20. We have 8 consecutive quarters where we've been consistently lifting our financial results. This is, of course, what we also aim to do in the future. Very focused commercially in order to bring the company to where it should be, to take out the potential of the great company that we have in our hands. Finally, as we have announced, we are now moving on to a listing at Euronext Growth. We firmly believe that is a listing venue that will be beneficial for the company and for the shareholders in the future, and we are looking forward to the journey that follows what we know are about to do. So with those words, I would like to close my remarks.
Fantastic. That's great. Tron, Septima, thank you indeed for updating analyst investors today. Can I please ask the attendees not to close the session, to be automatically redirected to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete, and is greatly valued by the company. On behalf of the management team of Benchmark Holdings PLC, I'd like to thank you for attending today's presentation. That concludes today's session. Thank you, and good morning to you all.